Welcome to today's Explainer. If you're looking for a clear, no-nonsense daily brief on the financial markets, you are in exactly the right place. Today, we're breaking down some absolutely massive structural shifts happening right under our feet. Specifically, we're looking at this recent crazy volatility in the semiconductor space. We're going to dive into the hard data to separate temporary market noise from true, long-term generational opportunities. Let's get right into it.
Here's our roadmap for this Explainer. We're taking a macro to micro approach today. First, we'll hit the global financial expansion, then the semiconductor sector surge. Next, we'll ask, structural shift or bubble? Then we'll cover the market shakeout, check out key support levels, and finish up with the long-term macro outlook.
Starting off with part one, the global financial expansion, and we're specifically looking at tokenization and 24/7 markets.
Okay, let's dive into this because, to really understand these micro movements in tech, we first have to wrap our heads around the massive fundamental expansion happening in global financial markets overall. We are basically standing on the precipice of a completely new era of trading. To give you a sense of the sheer scale here, just listen to this insight from Larry Fink. He's the CEO of BlackRock, literally the largest asset manager in the world. He recently pointed out that we are at the beginning of a grand expansion where everything will be tokenized. That means physical assets are going to be represented digitally on a blockchain, trading 24 hours a day, 7 days a week. So why does this matter to us? Well, historical data tells us that during these periods of massive market expansion, the inevitable pullbacks and corrections we see often end up being prime buying opportunities for those who are actually prepared for them. And speaking of being prepared and taking on risk, this number right here is exactly why we do it. Historically, the S&P 500 yields an average annual return of roughly 10%. In a world where we constantly see monetary degradation and inflation, that 10% acts as a really powerful natural hedge. But listen, there's a toll to pay for that average return, right? And that toll is volatility. You have to be willing to stomach the shakeouts if you want to reap those rewards.
Which brings us to part two, the semiconductor sector surge. We need to put this hypergrowth into context. Let's zoom into the microboom for a second. During the second quarter of 2026, we saw an almost unprecedented influx of money just pouring directly into semiconductor and memory ETFs. I mean, look at this staggering reality. Between late March and early July of 2026, the primary semiconductor index ETF skyrocketed by 115%. 115% in just a few months. That is the literal definition of a hypergrowth explosion. But of course, that instantly raises a critical question for anyone paying attention. Is this kind of growth actually justified, or are we all just riding a wave of pure hype? Well, to really understand the sheer magnitude of this shift, look at the sector's average weight in the S&P 500. Between the years 2000 and 2010, it sat at a pretty modest 4%, but today, it has absolutely exploded to a dominant 22% of the index's total capitalization. The sector has completely eaten the market. So, on to part three, structural shift or bubble. Let's analyze the fundamentals. We absolutely have to address the elephant in the room here. When a single sector goes from 4% to 22% and jumps 115% in just one quarter, pretty much everyone starts screaming bubble. So we need to figure out if this incredible AI-driven demand for infrastructure is just a temporary supply chain bottleneck, or if it's a permanent structural shift in the global economy. To answer that, we've got to look at the fundamentals. Take Micron, for example, ticker symbol MU. Thanks to massively concentrated demand and incredible pricing power, their profit margins surged from an already healthy 39% up to an unbelievable 85%. Now sure, some of this is absolutely due to an immediate bottleneck in building out AI infrastructure, but the underlying reality? This demand isn't just cyclical. The fundamental growth of these earnings has real long-term continuity because the entire world is transitioning to a totally new digital economy.
Moving on to part four, the market shakeout, and exactly how to navigate these corrections.
Now, remember what we said earlier about volatility? It's the price of admission. Financial markets are practically designed to shake out over-optimism. When everyone gets a little too greedy, the market inevitably corrects to expel them. And when you're navigating a drop, there's this really fascinating contrast in market mechanics going on. On one side, you've got the weak hands. During this recent surge, a massive flood of retail investors, like heavily leveraged retail traders in South Korea, for instance, borrowed huge amounts of money to buy at the very top. So when the market dipped, they were forced into liquidation, which violently accelerated the fall. On the other side, though, you have the institutional reality. A huge percentage of fund managers have actually drastically underperformed the S&P 500 this year. They missed that initial run-up, and now they're desperately trying to navigate this volatility just to catch up. So the drop isn't happening because the companies stop making money. It's just a mechanical shakeout of over-leveraged players.
This leads us to part 5, key support levels. Let's look at some objective market data. Okay, so if you know the fundamentals are still strong, but the market is busy shaking out the weak hands, where do you actually look to act? Well, you look at objective, data-driven support zones. After the initial June support levels failed, technical analysts had to recalibrate. Let's break down the numbers. These are the specific mathematically derived technical support levels where historical demand has pooled. For the general semiconductor ETF, the SMH, analysts are watching the 477 to 469 zone. For Micron, it's the 712 area, with a deeper key low to watch at 652. For AMD, we're looking around 409, stepping down to 393. And for NVIDIA, the target zone is 170 down to 164. Take a second to really absorb those, because by patiently waiting for these specific zones, levels that were established back in the spring of 2026, you're securing a much safer, mathematically sound risk-to-reward ratio. You aren't just guessing out there, you're letting the market come to you. Finally, part 6, the long-term macro outlook. We are looking forward to 2027. Let's pan back out and see how this all builds into the broader macroeconomic landscape. As focused learners, we always want to be looking to the horizon. We really need to ask ourselves, once this initial wave of AI infrastructure is built out, what actually drives the next wave of demand for semiconductors? Think about it. What happens when artificial intelligence transitions out of massive data centers into physical, real-world, everyday applications? Well, the answer is the impending structural shift toward automated labor and robotics. The future expansion of the labor market isn't going to be human, guys. It's going to be driven by machines. Just consider this incredible fact. A single robot requires roughly 50 times more semiconductor memory than a standard iPhone. Right now, it's really only the mega corporations like Amazon or the major auto manufacturers deploying robotics at that kind of scale. But mass adoption by small and medium enterprises and eventually everyday consumers is coming. And this continuous, non-cyclical demand acts as a massive, absolutely unstoppable tailwind for the entire semiconductor industry. So the crucial point I want you to take away from this is, the current market volatility we are seeing is not the end of the tech run. It's really just a consolidation phase. When you combine the expansion of global financial markets, the fundamental earnings growth we're seeing in semiconductors, and this massive incoming wave of robotics, the year 2027 truly represents a once-in-a-generational historical opportunity. The only question left is, are you going to let short-term shakeouts scare you away, or will you use the data to own the future? Thank you so much for joining me for this explainer, and I will see you in the next Daily Brief.